Stock market volatility persisted throughout March, and now the S&P 500 has delivered a total return of negative 4.32% for stock market investors in 2025. That being said, sell-offs like the current one get me more excited about purchasing stocks than when the stock market is going straight up and there seems to be no trouble ahead. Those are the times where I start to feel nervous and concerned, is when stock markets just go straight up. But when the stock markets are coming down, I'm finding a lot of stocks that are trading at attractive valuations, and I'm finding a lot of buying opportunities. That will be the subject of this video. I'll highlight 9 of my best stocks, or my highest rated stocks, to buy right now in April.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned that I would reveal my top 9 stocks to buy right now in April. In addition to that, I'm going to give you a bonus and reveal how my portfolio of stocks have performed in 2025 so far. But first, let me share with you the 9 best stocks to buy now. And those are, in no particular order: Nvidia, DraftKings, AMD, Alphabet, Amazon, Eli Lilly, Oracle, Pinterest, and Uber. Now, one thing you'll notice, as I have laid out here, in addition to the names of these companies, is their valuation according to the forward price to earnings. They are relatively cheap. I've not found companies selling at these valuations for a couple of years now. Ever since we had that rally starting in 2023, valuations have felt a little bit rich overall. But in these last few weeks, we've gotten a sell-off, and some of these companies like Nvidia are trading at very attractive valuations. Nvidia is trading at a forward price to earnings of less than 19. I mean, this is cheaper than some consumer goods companies. I don't think I've seen Nvidia trading at this kind of valuation in several years. And you've got DraftKings trading at a forward price to earnings of 14, AMD at 16, Alphabet at 15, Amazon at 25, Eli Lilly, okay, 28. That's the most expensive one on this list, but Eli Lilly, with its weight loss drugs, has great prospects ahead. Oracle at 21, Pinterest at just 13.84, and finally Uber at just 17. These are all growth companies with expanding markets, growing cash flow, and good market competition that favors long-term investors. But you're able to buy these at lower valuations because of the increasing fear in the marketplace right now. And those fears, some of it is justified, right? Well, I wouldn't call fears justified. I would say that investors should be accounting for the decrease in earnings as a result of tariffs, right? That's all you need to do. You don't need to be afraid. We just need to account for the cost of the tariffs, right? If it's going to be 20-25%, then the companies that are exposed to those markets, you've got to account for that rising cost of goods sold and account for the fact that they're going to be able to make some adjustments. They won't have to fully absorb a full amount. They can offset some of those, and thereby you can adjust their earnings downward as a result of those increase in tariffs. And that's if those tariffs remain in place all year. We don't know that yet, but we can move forward as if they were going to remain in place. What you've also noticed is some of these companies are not exposed to tariffs at all. Companies like, let's say, DraftKings, which is primarily US based and is an online gaming company, not really exposed to tariffs, but still you need to account for the change in consumer behavior as a result of tariffs. If there's going to be slowing economic activity, job losses, slowing economic growth, then that's going to impact every company on this list, whether they're directly exposed to tariffs or not. That's why I will account for that in all of these companies I'm evaluating, is either they're directly exposed to tariffs or they're indirectly exposed to tariffs. No company is immune to the tariffs that will be put in place, that are already put in place. We just need to account for how much and for how long will these companies suffer from the rising cost of goods sold and increasing inflation as a factor that decreases investor enthusiasm. When inflation is increasing and tariffs are inflationary, when inflation is increasing, investors are less interested about investing because their purchasing power is diminishing. Because if you have $100 today and you don't spend it and you wait to spend it next year, you invest it for 1 year, if the cost of goods increases by $5, you've got to earn at least 5% just to break even with inflation. And so inflation just adds an extra return that investors require to invest their money. And so across the board, for bonds, stocks, anything, investors require a greater return when inflation expectations are increasing, which is what's been happening over these last several weeks, is that inflation expectations have been increasing. So I mentioned the S&P 500 is down over 4.3% year to date, and I wanted to share with you how my portfolio was performing. So before I share with you a separate spreadsheet that takes the average of all of the stocks, I wanted to show you the returns, the year-to-date returns on the 9 stocks that I recommended as the best stocks to buy this year. This list has stayed the same all year. I created this list. I first published this list in January 1st, and I've had these rated as top stocks to buy. And when I did my portfolio evaluation at the end of January, at the end of February, the results were really good and I had outperformed the market significantly. But at those same times, I warned investors not to get too comfortable, not to just take my stock recommendations as guarantees and run with it, to do your own due diligence and not expect me to beat the market every single month, every single year for the very long term. That's a very difficult thing. I may or may not be able to do that. Time will tell, but don't expect that, is what I'm trying to inform investors. So out of the 9 stocks that I highlighted, only 3 of them are positive now year to date, and that's Eli Lilly, Pinterest, and Uber. The rest are all down, and they're down more than double digits. Now looking at it overall, taking the average, my portfolio is down 6.34% year to date in 2025, whereas the S&P 500 is down 4.32%. So my portfolio of stocks is down more than the S&P 500 is down. So in other words, I'm underperforming the market, and this is especially undesirable because I'm underperforming the market when the market is also down. So it's just a lose-lose scenario here. I would rather have underperformed the market, but the market be up, and that way we're still making money, but maybe we didn't make as much money as the market made. This is the worst side of the scenario where we're losing money and we're losing more money than the overall market is losing. Still, at current valuations, I expect these 9 stocks to outperform the broader market for the rest of 2025, and I like these stocks at current valuations. I'm excited to announce a brand new private Discord to our channel members at the VIP Discord tier. It's a great place to directly connect with me, ask questions, and engage with a community of like-minded investors. Spots are limited, so join us today.